Welcome back, ladies and gentlemen. Now let's talk about the double entry concept. We had talked about it earlier, but we are revisiting the concept. And the concept states that every financial transaction has equal and opposite effects in at least two different accounts. It is used to satisfy the accounting equation assets is equal to liability. So every transaction has to affect at least two accounts in the opposite direction. So let me just try to explain this with the same account. So for example, here we have three different accounts here. We have capital account, and we also have a bank account and cash account. So here we are having we are assuming that you started a business with 100,000 shillings, and you transferred 50,000 to bank account and 50,000 to cash account. So when you start a business, that amount that you are injecting to the business that is coming from your pocket, we are calling that one capital. So the capital account here will be credited. The credit side of the account of the capital has been affected, and then in equal opposite direction, this amount has been transferred to bank account and cash account. So the two accounts will be debited. Cash has been debited with 50,000 shillings, rather bank, and cash also has been debited with 50,000 shillings. So we have opposite effects, one for the credit side and two for the debit sides, where we are debiting bank and debiting cash, and then the capital account has been credited. So the accounting equation that says that assets is equal to liability plus capital is being certified in the sense that we have asset here bank, and we also have cash, and when you add these two assets we have 100,000. But here we're just studying a business. You've not done any purchase, so there is no liability. So the total assets here being 100,000 equal to our capital, which is equity, which is also 100,000 shillings. That's what we mean by every transaction will affect at least two different accounts. So let's just go back to our slide. So again, we are saying that it is used to satisfy the accounting equation assets is equal to liability. That one we explained. And then we are saying that debit entries are ones that account for the following effects: increase in assets. Right? From our previous example, where we are showing that the double entry concept, how it affects different accounts, at least two. We debited assets, so the asset account was increased by the amount of value that was debited, and then increase in expense. And we had said earlier that expenses are always debited. So when you debit an expense account, you will increase the value, or rather increase the expense within that account. A decrease liability. So we also said earlier that all liabilities are credited. So when you credit a liability, you increase the value of the liability. When you debit a liability, you will decrease the value of a liability. For an example, let me take you back to Excel again, just to explain what I mean. Let me give you an example like this one for payables. This is a liability, and then you also have Also have cash account here, which is an asset. So the balance carried down as an asset here is 25,000. The balance carried out here as a liability is also 25,000. Let's assume that now you want to debit the payables account. You want to reduce the value of the liability. So these are payables. So you need to pay this amount. Let's assume that on maybe 3rd or maybe 6th of January, 6th Jan, from bank, you paid 10,000. So now you are reducing the value of this liability. You are debiting the account. So the amount remaining here will, as cash carried down, will be, the balance carried down will be 15,000. So the value of the liability has been reduced by debiting the account, and then the asset, the cash account, have been reduced by paying bank, rather paying payables 10,000. So here is 6th of Jan. I'm just trying to give an example. So here we have payables. Here again we also have 10,000. So we are crediting the account, cash account. So the value of that account is being reduced, being decreased. Initially we had 25,000, but after paying bank 10,000, we debited this cash account by 10,000. So we reduced the amount in the bank. Then we credited, we debited. Let me not confuse you. We credited cash account by 10,000 and debited the payables account by 10,000. So payables was reduced by 10,000 by debiting, and cash account was reduced by 10,000 by crediting. So when you credit an asset account, you reduce the value of that account, and when you debit the liability account, also reduce the value of that account. So let's go back to slide. So again, you're saying that decrease equity. So when you debit equity, you decrease. So like for example, now you have injected 100,000 as capital, but later in the future you're saying, no, I injected 100,000, but now I only want to put in the business 90,000. It means that your account has to be reduced by 10,000. So reducing your account by 10,000, it means that we'll debit that account because equity is always credited. But now that we want to reduce it, we'll debit the account by 1,000 and we'll credit back or cash by the same amount because we are giving you back 10,000. Again, we're also saying that decrease in income. So when you debit income, you will decrease the value of that income account. So that I think is self-explanatory. And then we're also saying that credit entries are ones that account for the following facts. Decrease in asset, because all assets are debited. When you credit the account of an asset, you will reduce the value of that asset. Decrease in expense, again, all expenses are debited. So when you credit the expense account, you are reducing the value of that expense. Increase in liability. So we've talked about the liabilities. Liabilities are always credited. So when you want to increase a liability, you will credit. An example, now you've purchased goods on credit. So you'll pay later. Goods purchased on credit means that you'll be paying later at a given date. You purchased goods worth 10,000, so a liability account now is 10,000 shillings. Again, you've gone back to the supplier you are again purchasing some goods on credit worth 5,000 shillings. So the additional 5,000 shillings will again be credited to this liability account. So you are increasing the liability account. The same applies to equity. When all equity, we've talked about capital. So all capital account will be credited. And when you debit the capital account, you'll be reducing the value of that capital account. And capital account is just equity account. And then increase in income. So when you credit income, you increase, but when you debit income, you reduce. For example, let's assume our income is revenue. So revenue always credited. You made sales to a customer, and then the customer decides to return some goods. So the goods that are being returned, I decide now you need to recognize that the goods were not sold. So you need to debit the account for sales. So when you debit the account for sales, income will be reduced, and when you credit the account for sales, the income will be increased. And then you're saying that double entry is recorded in a manner that accounting equation is always in balance. So what we mean here, let me take you back to Excel. So like now we started with the capital of 100,000, and then the 100,000 was transferred to cash account and bank account. And then we are saying that at every transaction, accounting equation has to be satisfied. So here we've started a business with 100,000. So we must credit the capital account with 100,000, and then the amount has been transferred to bank account and cash account, 50,000 both. So we'll debit bank account and we'll also debit cash account. So the double entry concept, rather the accounting equation here is that the capital here is 100,000 and the asset here is a bank and cash is also totaling 200,000. We've just started trading, so there's no liability. So here liability here is 0. So assets is equal to liability plus capital. It means that asset is 100,000, which is equal to 0 liabilities plus capital, which is 100,000. So let's go back to our slide. So the double entry is recorded in a manner that accounting equation is always in balance. So this one we've explained. So again, we also have classification of accounts, and we are having two major classification of accounts. We have personal accounts and impersonal accounts. So when we talk about personal accounts, we are talking accounts of persons, accounts of creditors, accounts of customers, accounts of employees. Those are personal accounts. Personal accounts. And then we also have impersonal accounts. So impersonal accounts has been categorized into two. We have real accounts and we also have nominal accounts. So when you talk about real accounts, we are talking about property, we are talking about assets, we are talking about motor vehicle, we are talking about furniture, we are talking about machinery. So those properties are what we are calling or rather when we maintain the accounts of such kind of properties, we are talking about real accounts. When we talk about nominal account, we are talking about such accounts that are not real accounts, and they are not also they are also not personal accounts. So nominal accounts will be such kind of accounts like income account, expense account, and losses account. So we also have down here balancing off of accounts. So what do we mean when we talk about balancing off of accounts? So this we can explain with the Excel workbook. So let me use this example again to explain the same thing. or let me just try to use this one for current asset entries. So here we have a cash account, and within cash account here we have a debit side and credit side. So when we have cash account, we've bought stock 15,000, treasury we've paid 15,000, and advances also we've paid 15,000, and then the payables as well has been paid 1,000. So when you check on the left hand side, we have 70,000. But when you check here, that amount that we've paid is about 55,000, meaning the balance that is remaining in that account is 15,000. This is when we are showing balance carried down. So balancing of accounts, it means that we have to show the balance carried down so that the credit balance, the credit side must be equal to the debit side. Like now we have this side 70,000. So this side also we have 70,000, but the balance carried down, which is the value that balances of the accounts is 15,000. So when you check again on the bank account, we also balanced off the account by having a balance carried down of 15,000. We started with 75,000 shillings, and then we had a prepayment of 18,000 shillings. So the difference between 75,000 shillings and 18,000 shillings was to balance off the account. So we have 57,000 shillings as balance carried down. So this account has been balanced off. The same applies to this other account, stock account and payables account. So ladies and gentlemen, I hope you've understood what it means by balancing off accounts. So I want us to stop at that, and then when we come back in the next video, we'll be talking about the trial balance. So thanks a lot for watching, and let's meet on the next video.